If you have been looking for the secret to building wealth in the stock market, look no further. This simple investment strategy has beaten the market for decades, and it is so easy even your dog could do it. All you have to do is buy low and sell high. Sounds simple, right? Well, it is. But that doesn't mean it's easy. Just ask any retail investor who has tried and failed at this strategy. But there is hope for you. You see, while buying low and selling high may seem simple in theory, it is actually quite difficult to do in practice. That is because it requires a great deal of discipline and emotional control. Most investors can't handle the pressure of making these tough decisions when the time comes. That is why we are going to teach you how to stay calm and collected when everyone else is panicking. And we will also show you some practical tips on how to buy low and sell high without losing your shirt in the process. So make sure to watch until the end, because by then you will know everything you need to beat the market. Okay. Let me tell you something. As an investment advisor, I get asked all kinds of questions from my clients. Some want to know what stocks to buy, others want to know when to sell. But one of the most common questions I get asked is how to beat the market. And the answer to that question is simple. Buy low and sell high. Now, if only it were that simple. You see, beating the market is not as easy as it sounds. That is because the stock market is a very efficient place. There are literally thousands of analysts out there whose job it is to find the next hot stock. And with all of that competition, it's pretty hard to find a winning stock. However, there are ways to increase your odds of success. One way is to invest in index funds. Index funds are a type of mutual fund or ETF that tries to match the performance of a specific market index. For example, the S&P 500 index fund would hold the same stocks as the S&P 500. Since it is impossible to beat the overall market, index funds are a great way to get average market returns without having to do any research. Warren Buffett, the world's greatest investor, even said that the best way for average investors to build wealth is to invest in low-cost S&P 500 index funds. Another way to beat the market is to take advantage of market inefficiencies. This can be done in a number of ways, but it takes a lot of research and discipline. Fortunately, there are now ETFs that have been created to do just that. These ETFs are known as arbitrage ETFs. Arbitrage ETFs are designed to profit from temporary price discrepancies between two securities. For example, let's say a company announces that it will be acquired for $100 per share. The stock price rises to $100, but it hasn't quite reached $100 yet. An arbitrage ETF could buy the stock and simultaneously sell a contract that obligates it to sell the stock at 100. If the stock price reaches 100, the ETF makes a profit. Of course, this is a very simplified example, but that is how arbitrage ETFs work in general. They take advantage of temporary price discrepancies in the market. Now here's the best part. Arbitrage ETFs have been around since the early 1990s, and they have consistently beaten the market. From 1990 to 2018, the average annual return of an arbitrage ETF was 12% versus only 8% for the S&P 500. What is more, arbitrage ETFs have also been much less volatile than the overall market. This is because they don't really care about what the overall market is doing. They are only interested in exploiting price discrepancies. This makes them a great option for investors who want to beat the market without taking on extra risk. Okay, so what is stopping you from creating your own arbitrage ETF? Well, nothing except for the fact that it would cost millions of dollars to set up such a fund. But don't worry. There is still a way for you to take advantage of arbitrage opportunities without having to set up your own ETF. You can simply invest in existing arbitrage ETFs. Some of the most popular arbitrage ETFs include the JPXS Multi-Strategy ETF, the Direction Daily S&P 500 Bear 3X Shares ETF, and the ProShares Ultra VIX Short-Term Futures ETF. These ETFs have all outperformed the S&P 500 over the past decade, and they have also been much less volatile. If you are an investor who wants to try to beat the market, consider investing in an arbitrage ETF. It's a simple strategy that can be very effective. In fact, I recommend that all of my clients allocate at least a portion of their portfolio to arbitrage ETFs. Okay, So how do you do it? As you can see, investing in arbitrage ETFs is a simple strategy that can be effective. All you have to do is buy low and sell high. Well, it's not that simple, but it's not rocket science either. Now you need to figure out when to buy and when to sell. To do that, we will have to use technical analysis. Don't worry, it's not as complicated as it sounds. First, let's talk about when to buy. You want to buy when the price is low. This may seem obvious, but it's important to remember that stock prices fluctuate constantly. Just because the price is low today doesn't mean it will be low tomorrow. That is why it's important to use technical analysis to identify buying opportunities. One way to do this is to use a moving average. A moving average is simply the average price of a stock over a period of time. By using a moving average, you can smooth out the ups and downs of the stock price and get a better sense of the overall trend. If the stock price is below its moving average, it is considered to be oversold and ripe for a bounce. That is when you want to buy. When to sell, on the other hand, is a little more complicated. You don't want to sell when the price is high because then you will be giving up potential profits. On the other hand, you also don't want to sell when the price is low because then you will be locking in your losses. The key is to find a balance between the two. A good rule of thumb is to sell when the price reaches its moving average. This way you will be able to capture the upside while also limiting your downside risk. Of course, this is just a general guide. You may need to adjust your strategy based on the specific circumstances of each trade. For example, if you are in a long-term trade, you may want to hold on to your position for longer, and if you are in a short-term trade, ultimately, it is up to you to decide when to buy and when to sell. But hopefully this gives you a starting point to work with. Okay, now that you know when to buy and when to sell, it's time to learn how to place your trades. I am gonna give you 3 trading tips that will help you buy low and sell high like a pro. Tip number 1. Use limit orders. A limit order is an order to buy or sell a stock at a specified price or better. For example, let's say you want to buy 100 shares of Apple stock at $100 per share. You would place a limit order to buy 100 shares of Apple stock at $100 or less. Limit orders are a great way to ensure that you get the price you want. They also allow you to sleep at night knowing that you won't be paying more than you intended to. Tip number 2. Diversify your trades. This means that you should never put all of your eggs in one basket. If you are buying a stock, make sure you are also buying other stocks as well. This will help to reduce your overall risk. For example, let's say you buy 100 shares of Apple stock at $100 per share, and 100 shares of Microsoft stock at $100 per share. If Apple stock goes down in price, you will still have Microsoft stock to fall back on. Tip number 3. Don't be afraid to walk away. If you are ever in a position where you feel like you are getting ripped off, just walk away. Don't be afraid to miss out on a trade if it doesn't make sense. Remember, it's better to walk away with nothing than to stick around and lose everything. So there you have it. Those are the 3 simple steps to beating the market. If you follow these steps, you will be well on your way to financial success. But remember, success doesn't happen overnight. Be patient and stick to your plan and you will eventually reach your goals. Thanks for watching and good luck in the market.